Good morning and welcome to MarketCast 33. I was just a child when we started this whole series. And here we are, we're back from our summer break, live from the AF Oliver offices here in Bournemouth, where the sun is doing its very best to break through. And we find ourselves in a fiery pit of controversy. Why? Well, it's the thing that's actually thrown all of our forecasts and predictions up into the air. And that, of course, is the Rachel Reeves budget. Coming up now, it's announced, the date has been announced for November the 26th. November the 26th. Now, it's quite extraordinary. That's 12 weeks away from where we are now. And in the meantime, the rumour mill is spinning at an extraordinary speed. If it was one of those windmills that actually powers the UK, they'd have turned the damn thing off by now because it was spinning too fast. And of course, the media love it, don't they? They take all this stuff, they propagate it, they add it in, and they stick bits on and elaborate a cherry on top and get our consumers worried with us. Now, we will cover all that clearly, but I think there is no doubt whatsoever that Rachel Reeves will be scrutinising the property market to see if there are any easy pickings there, some low-hanging fruit. She's got to find billions. The rumours run from 20 billion to 60 billion and all points in between. Your guess is as good as mine. I watched her on a news bulletin just last night when she said she doesn't recognise the numbers that were being quoted to her. But one thing's clear. She's not able to touch national insurance, even maybe employers' national insurance this time round. She's not allowed to touch income tax, and she's not allowed to touch VAT because the Labour Party have hogtied themselves to those policies. The property market looks like an easy target. Now, I'm going to leave that till the end because I've got some thoughts on that, thoughts on how it's going to affect the market in Q4, and maybe some thoughts about what the developers can do to counter some of the issues we're going to face as a result of that. Something that I am going to call budget paralysis. And we'll cover that as we go through. I think, as ever, we need to kick off with just taking a summary look of where we are right now and at some of the key data before we get into what's coming next and the best way to manage that. First of all, well, the wait until November 26 is going to be painful. And the trouble is we don't quite know yet how that is going to affect consumers. We'll do that in more detail later. Rumours of property tax changes are rife, and that's being done deliberately. I call it running the flag up the flagpole to see who salutes. Let's tell them all that we're going to take their property away and confiscate it for the government. Oh, God, that was a terrible reaction to that one. All right, we won't do that. Well, let's tell them we'll do... You know what I mean here. Just getting back to where we are in fact rather than supposition. Completions rebounded as we said they would. This was after the stamp duty hiatus. Obviously, the change in stamp duty arrangements at the end of March caused a huge spike like they always do. And then, of course, they caused the drop afterwards, as we said they would. So the completions now coming back up. I'd stuck with my 1.2 million transaction volume forecast for 2025, which I've had since last December and I've not moved from. I'm a little bit worried about this. And I think this budget issue and the rumours that have been circulating within the last week or so could affect volumes in Q4. More on that later. Could put my 1.2 million volume in jeopardy. Even if it does, it's not going to be by a huge amount. The nationwide numbers came back to where we thought they were going to be in August. They came out a couple of days ago. I'm sure you've seen them. Of course, the July number took us all by surprise with its uptick. I think we're back now on the trend that we were expecting to see. Consumer confidence staying remarkably resilient. It's had a bounce back. I'll spend some time on consumer confidence in a moment or two. There was an interest rate cut while we were away on our summer break, and we're now down to 4%. However, borrowing in the UK, long-term borrowing for the UK, is now at its highest since 1998, 27 years since borrowing costs were this high. And that, of course, means all bets are off in terms of consumer interest rates cuts. Now, at the moment, we haven't seen that feed through. You can still, for the sharp-eyed ones amongst you, you can still get sub 4% mortgage rates out there from one or two lenders. And the lenders are still aggressively looking for business in the market. And there are all sorts of things going on with allowing first-time buyers additional multiples now. They've gone beyond their multiple levels that they had before. Relaxed mortgage lending criteria, all the stuff that we've covered before on MarketCast, that's going on. So the market is still very competitive, but there's definitely that longer-term money is edging up in its cost, that's for sure. All right. So let's just take a look then at what's going on in the media right now. And the reason this is important to us, I know that you know all this stuff that's in here, but it is very important that we get a sense of what the consumer is consuming in their day-to-day media, both in terms of trade press and in terms of the consumer press, because that affects sentiment, and sentiment affects behavior. We all know that. And just picking up some of the stuff from the last couple of weeks. This was yesterday, actually, in The Guardian. UK house prices in surprise fall. Now, you can pick bones out of the nationwide price index. You know, if you're a regular MarketCast viewer, you know that that's the index that we use to give us our guide on what we believe, to show us how the market's generally moving. In terms of how useful it is on a day-to-day basis, I think that's seriously limited because of the enormous variety in UK markets from Blackburn to Bournemouth. There's about 7.5% difference in the way that the market is moving. But the consumer takes this stuff in and the press love it. They love the nationwide index. It always raises headlines, whether it rises or whether it falls. And The Guardian have picked that story up there. Down valuations. I don't know whether you're experiencing any down valuations at the moment, but they are both in consumer and trade press right now. This is today, by the way. This is Estate Agent Today, which is the estate agent's trade press. There's this one and there's Property Industry Eye. And just this morning, down valuations rise as surveyors become judge, jury and executioner warning. Heavens, that's emotive language, isn't it? Clickbait? No. I think they really do mean it. Over here again, this was this morning, the November statement. So this is the budget they're referring to now. Could be one of the toughest second budgets in living memory. You're going to see a lot of this over the next 12 weeks as the press pick up. It's a really easy piece of editorial to write, isn't it? And you can make the headlines as shocking as you like because it's all supposition. You'll see a lot of that coming up. Up in here, this is mortgage and property investment, inflation surge. Mortgage and property experts weigh in on rising costs. Of course, we had the inflation numbers in August, which weren't good news. 3.6 to 3.8% RPI. So yeah, that's the sort of stuff we've going on. There's a big mix in there. Just one last story I'll pick out of this. And this is a couple of weeks old now. This was the Money Week story on here. Property valuations wiped millions off stagnant housing market. It's been a tough summer. There's no question about that. Stagnant, I found to be a very surprising term indeed. Finally, just over here, this story in the Telegraph this week, Labour is teeing up to destroy the private rental market. There was another story as well in the FT day before yesterday, talking about private landlords and investors selling out because of this. Well, it's another rumour. It's on that rumour mill. National insurance on rental income from rental properties. There's a lot of this going to be happening over the next 12 weeks. Prepare yourself. Better still, I've got a plan. We'll come to that towards the end of MarketCast. Let's take a look at the important dates and the important numbers. Inflation numbers, the next set of inflation numbers, they're so important to us, come out on September 17. I've got something important to tell you about inflation this morning. And of course, if we actually look currently at how the market's moving, this is the property mark index. Their new numbers only came out yesterday and they're a little bit difficult to decipher. What I've given you here is the percentage of all the members of the Property Mark organisation saying that they've done their deals at asking price or better. And you can see it's nudged up almost to 2 out of 10, almost 20% of deals being done by Property Mark agents at the moment are being done at asking price or better. Crucially, let me tell you, the initial asking price is massively important. Both Rightmove and Zoopla, which between them have an enormous chunk of the online market, portal market, both say the same thing. We'll come back to that in a minute, but in a minute or so. Asking price, massively important. Here are the inflation numbers then. So we've got this uptick here. So CPI, the consumer price index, which is the chosen measure, the one that all the newspapers and the television pick up, has jumped up from 3.6% to 3.8%. But for us, for this professional audience watching this MarketCast, look at this number here. This is the OOH number. These are the owner occupier housing costs. That index continues to fall and in fact came down from 6.4% in June to 5.5% in July. So in terms of the people that generally we are talking to, that is very good news indeed. Much better news than over here on the CPI. That's going to have so that's having an effect on our consumer confidence, and it's certainly having an effect to the people that we're talking to in terms of their living costs. I've not put, because we're short on time, the wage inflation chart in here, but let me tell you, wages, although wage inflation fell in July, it is still running ahead of property price inflation, which essentially means, if you want to be just basic about it, houses are getting cheaper if you're working. So to pick the bones out of that one. So Monetary Policy Commission meets on September 18th. So we've got the inflation numbers, and then literally the following day, we've got the MPC meeting. I'm sort of thinking a cut now is unlikely. When we were talking together back in June, I said, well, there's every chance we could see both August and September meetings, 25-point cut. Well, we got the one in August. We've had a bucket full of bad news since then. I'm doubting very much whether we're going to see another cut in September. We'll wait and see. Just as a refresher, you probably don't need this. I'm not going to spend a lot of time on it, but this is where we've been. So this was our post-COVID interest rate, literally scrabbling along the bottom there. Or in fact, actually, it was the post-2008 crash interest rate that has literally bobbled along the bottom. And then when we all came out of COVID, 2021, 2022, 16 interest rate rises in the space of 37 seconds. And that brought us all the way up to here. And now we've started coming back down the other side. Interestingly, the first cut was in August 2024, just over a year ago from where we are now. And we have gone from 5.25% down to where we are now at 4%. So 1.25% cut during that time. I still think there's more to come. There's stuff going on. Geopolitically, there's stuff going on. The bond markets have such a big influence on this. So I'm no economist, as I so often say on this MarketCast, but I still think there's more to come yet. I think we'll see at least one more cut before the year end, despite the issues that we face. In terms of the mortgages that people are paying, these are the latest numbers I've got. These are correct as at the end of July. So they're a month old now, which is a little bit long in the tooth for these. I did check first thing this morning to see if there were new numbers available, but you can still see generally on a 2-year fixed mortgage over the different loans to values, you can still see that generally the trend is down. And if you're looking at a 2-year fixed at 90%, it's under 5%. 2-year fixed all the way down here at 60%. The average rate is only just above 4. And as I showed you on those press stories right at the start, you can get 3.75% if you're good and you're searching. So where does that leave consumer confidence now? Now, please bear in mind that the date that this data was collected was between the 1st and the 14th of August. That's very important. So that's before the new budget date was floated. That's before the Treasury started putting out these rumours about national insurance on rent and doing away with capital gains tax relief on your main residence, and also all those other rumours that you've seen flying around over the last week or so. But look at this. This is consumer confidence. So although consumer confidence generally is still well below this yellow line, which is the going nowhere. So that's half the people think things are going to get better. Half the people think things are going to get worse. We're still well in negative there. But heavens, it's taken a real uptick over the last 3 months. So right, real quick, lightning quick run through. The red line, that's the overall index score. GfK asked 2,000 people, are things going to get better or worse over the next 12 months? If a majority say worse rather than better, then we're below this yellow zero line. If the majority say better rather than worse, we're above the yellow zero line. It's as simple as that. That's the overall index score climbing up from another low point here. So this blue one down here that actually looks like it's intended for viewers in Australia, it's so low. You can see even that's taken a bit of a recovery. That's when they say, do you think the UK economy is going to get better or worse over the next 12 months? And you can see where that is and where it's been now pretty much since COVID. Let me tell you, when that blue line eventually, if it ever does, pops its head up above that yellow line, then we can all open the champagne because we're in for a bit of a party. It's not going to happen anytime soon. The green line here is it a good time to make a major purchase, whether that's a car or a kitchen or a house over the next 12 months? And even that has climbed up, still in negative, but that has climbed up too. The one that is, I think, is extraordinary is this line at the top here, where they say to people, do you think your own personal finances are going to get better or worse over the next 12 months? And you can see that we've got just this tiny little people are resilient, and wage inflation is outstripping general inflation. Wage inflation is outstripping house price inflation. Like it or not, bizarre as it may sound, people are better off than they were. I know that sounds like an extraordinary thing to say, but it's true. Quick look at the right move numbers. I'm going to dash through these because I want to save the end bit for the real crucial thing about what we think is going to happen in Q4. This was the August number from Rightmove, came out a couple of weeks ago. And you can see we've seen now 3 consecutive monthly falls in asking price. No surprise. The asking prices were too high and they didn't reflect the way that the market was behaving. Not the slightest bit surprised about that. I want to show you this one line in the Rightmove, in the executive summary on Rightmove. Oh, I've jumped to, hold on, there. So look at this in this line. It says here, I'm going to read it to you because it's that important. The overall average time to find a buyer is now 62 days. However, it takes an average of 32 days to find a buyer if a property doesn't need a price reduction, against 99 days if it does. That is explosive detail, isn't it? Have a think about that. And Zoopla are saying exactly the same thing. I think Zoopla say it takes 2.4 times as long to sell a property if you put it on at too high a price and you have to reduce that price after. So setting the asking price when you go to market is absolutely critical. Buyers are savvy now. They will look at how those prices were set. You can't get away with sneaking in a price reduction if a buyer can see the price was there and now it's there. So that's a really important thing to think about. And certainly in terms of new build and how we present a proposition. So rather than presenting price cuts, doing other things. Well, the Nationwide have been in the news this week because it's finally come back to where we thought it was going to be and where it was in my forecast back last December. Just saying. Compare it to Savills back last December. Sorry, Savills, if you're watching this morning, but it's true. Annual house price growth softens in August, and you can see here it actually came down 0.1, which means the annual rate now on Nationwide is 2.1. To be fair, that's still slightly above where I thought it was going to be this time of the year, but importantly, it's now back as we expected it to be. And if we look at the 3 month on 3 months numbers, which I think is the Nationwide's most reliable measure, you can see there that it is now coming back down on this trend line that we expected to see. And certainly it's in line with what we forecast back last December. No surprises there, really. Zoopla, They've now got UK house price inflation averaging out as at the end of July at 1.3%. I completely see that. The Zoopla algorithm is probably my favorite, where they combine completion values, asking prices, and mortgage approval prices, and they come up with this algorithm. I think that's a very good, reliable one there. Haven't got time to do too much with this, only to say this. Buyer demand is still 4% up on where it was last year. But if you looked at these numbers last month, you'd know that was actually 11% higher than last year. So this is this summer dip that we're sat right in the middle of. And I know how difficult that is right now. So flow of new supply is almost dried up. That in itself is interesting. Budget paralysis element coming on in here. Stock of homes for sale is about 10% higher than it was. It's the shift from sellers to buyers market. Mortgage approvals are repairing themselves. The numbers just over 65,500, I think we had in July. And of course, we know the magic number on mortgage approvals is 66,000, because 66,000 mortgage approvals equals 100,000 transactions. 100,000 transactions gets us to 1.2 million a year. It's the magic number. We know that, don't we? The famous 5. That's coming back to where it was. RICS July survey. I'm going to spend moments on this, just 2 slides on this, okay? This is the first one. And in fact, I think I took 1 out because I need time at the end. These are the sales expectations of the surveyors, volumes. This is where surveyors believe volumes are going to go. Now, don't forget here, so this works the same as the consumer confidence numbers. So if the majority think it's worse, it's going to be below this line. If the majority think better, it's above it. The mauve line is that over the next 3 months, look at this, that's just down on 0 now. So the surveyors are split 50-50, with some believing that volumes will fall over the next 3 months, some believing that they will go up. What's really interesting is the annual number, this azure dotted line here, is only just now in positive. They are literally split right across the board, the surveyors. And when you turn that to values and how the surveyors believe that prices are going to go over the next 3 and 12 months, well, look at this. These are the surveyors. Remember those down valuations? And I forget some of the terms they used. Judge, jury, executioner. And you can see here now, the surveyors over the next 3 months believe that prices are going to fall. And these are the people that are doing those down valuations, by the way. They are still, over the 12 months, on balance, the surveyors believe that prices are actually going to hold up. Right. Let's have a think about what's going to come in Q4. How is this budget going to affect things? Well, let me tell you, this is, I think, what we've got to get our heads around here. Now, look, the subliminal effects of geopolitics that we all read about on consumer confidence is one thing, but the very liminal effect of deliberately putting rumours out about what might be coming in the budget and how they might be attacking you, the government might be attacking your assets, well, that is another thing altogether. It's destabilising and it's paralysing and it has an effect on consumer sentiment. But with what's going on at the moment, the rumours it's like a seesaw. Let me explain what I mean by that. So let's just pick up 3 of the putative measures that the Chancellor might take in the next budget. A change in stamp duty. Everybody sees that as a bad thing because stamp duty is a tax that brings in £10 billion a year. She ain't going to be giving anybody any of that back. It's only going to get worse, isn't it? So whether you are a buyer or a seller, you think negatively about that. Here we are on the seesaw. That's you going down, your sentiment. Changes in stamp duty. What's important is that always drives behaviours. If people believe that stamp duty things are going to change negatively come November 26, they are prone to act more quickly than that. What about a shift in liability? This is another rumour that's been put about where stamp duty, instead of being paid by the buyer of a property, gets paid by the seller of a property. Well, hardly surprising that buyers were going to think about that positively. sellers thinking about that negatively. Here we go. Here's the buyer. There's the seller. This is that sentiment seesaw that's going on. I think buyers have also got to bear in mind that sellers are probably going to adjust that price to take account of that. But again, it affects this sentiment and affects behaviors. What about the replacement of stamp duty land tax? This is another rumour that's being floated out right now. So take stamp duty away altogether and then just charge everybody a property tax on an annual basis. And there's a lot of talk about it will only be on properties £1.5 million value and over. But who knows? Because they're deliberately doing this, just putting these rumours out there. Well, of course, for people that are actually buying and selling, that's positive on both sides if that happens. So in other words, if everybody in the UK, whether you're buying and selling or not, are sharing the burden of stamp duty tax, well, then it's positive for buyers and sellers. The thing I'm trying to show you here is this just breeds, you're on the seesaw of good sentiment, bad sentiment, and it brings uncertainty. And the market hates uncertainty. It is the most damaging thing that you can bring in the market. This was last year, I should say September 2024. That was last year's matrix. This is this year's. This is where we've gone. And please note, I've added in this horrible red square down there because I think right now this is one of the most important things that we need to consider when we're actually putting marketing strategy and short-term marketing tactics together. It's what I call an uncertainty index. And I've planted it deliberately right in the high impact negative effect quadrant of my matrix, of my market factor matrix. For me, it's probably going to be the most important factor as we run up towards this budget. So what about the practical effects of that? Where are we going to go in Q4? Do excuse me, dashing at speed through this. So in terms of the nationwide index, so the actual index itself, this is very, very similar to the forecast that we set out right back last December, and it's now starting to fall in line. And we talked, didn't we, about the summer dip. I'm actually staying with my 1.5%, the 1.5% that I forecast at the beginning of the year. I'm staying with that. And if that level of inflation, staying in positive inflation, is correct, this is where average prices are going to go over the course of Q4. So pretty much sitting where it is. This is this budget paralysis that I'm talking around again. The big problem that we've got with this, that although prices may sit like this, and I believe they will, volumes, I think, are going to come under pressure. It's that uncertainty. Should we do this now? Shouldn't we do this now? In some cases, it can act as a spike, get people to move before the date happens. So we need to be thinking that through as well. So in the last 90 seconds that I've got with you, this, for me, this would be driving my thinking, strategically speaking. So we've got 12 weeks to wait till the budget. What are we going to do? Sit on our hands? We've got budget paralysis. We're staring it in the face. Very real danger. So we need to adjust our strategy accordingly. I think volumes are going to come under pressure. I believe that my 1.2 million I've stuck with for so long, I think is going to come under pressure and jeopardy. But I'm still staying with my forecast of price inflation across the year at 1.5%. New home share, I still currently think that that's set to be around 10%. But, and here's the real crux of this morning's MarketCast, we could do better. At difficult times, and I think we're facing a difficult time, look back at 2008, 2009, when new home share touched on 16%, because the industry was driven to do deals that otherwise they wouldn't have done. Whenever the market comes under pressure, the new homes industry has an opportunity to override that market, to introduce tactics that offset the negative effects of what's going on right now. Take away the uncertainty. I'm saying that if there is a strategy that you have that can deliver potential buyers and sellers certainty instead of uncertainty, well, then you take that away and you have an opportunity then to massively increased market share, certainly against the second-hand market, and the vagaries of completion dates that nobody quite knows what they're going to be, and the delays and the legals and all the rest of it. Things like part exchange, in my view, over the next 3 months are going to come into their own. It's going to be a hugely important weapon. What about indemnity against changes in stamp duty? People hate paying stamp duty. The one thing I can tell you with absolute certainty is that any changes in stamp duty rates or applications will dramatically affect volumes on a month-by-month basis. I know that for a fact, and so do you. And that means that we can actually bring certainty on stamp duty. Let's put some of our margin into doing that. What about pre-budget completion dates being guaranteed? All of these things. What I'm saying to you is the biggest problem that we face in terms of marketing strategy, the biggest issue we face is uncertainty over this budget paralysis. And I think if you have a strategy that is built around delivering certainty, well, then you will grab significant additional market share. And that's what it's all about, isn't it? Okay. All right. We've got a timer now, by the way. We've gone high tech. There's a little timer underneath this camera. So I know now I've just run 14 seconds over. I didn't think it was too bad. Next MarketCast date, yet to be confirmed, but we believe it is going to be Thursday, the 2nd of October. We will come back and confirm that. I really hope that this morning's MarketCast has given you some food for thought. Lots of thanks to Joan, and lots of thanks. And don't forget, we've got Luke now here on the techie side with lots of very interesting new technology. I'm loving it, actually. Big thanks to those guys. We'll see you a month from now.